Happy New Year. So the S&Ps have been on track. They're headed down. It's January 2nd now, 2025. We expected an early January low, and we still anticipate between the 5th and the 7th of January, the 5th comes out on a weekend, would be the next low point. And then, as we have said, we're expecting a rally in January that should go up into about the 21st of January. And then we expect a decline in February. Now, what's important right now is if you look at the strength of the rally in January, that tells a huge amount. We expect that if that rally is wimpy, I keep using that word every time, if it's not going to make a dramatic new high, if it stays under 6,300 on the S&P futures, for example, that's very bad. The future after that, the February could be very severe. If the decline that comes in presently, what we're going down into early January, if we go down into the 5,800 area or slightly below, and then we cannot rally much beyond the highs in January, or we don't even make new highs in January, then the February decline could take us significantly lower, somewhere between 10 to 20% in the next few months. We're looking for February to be severe and then potentially have a low early March, have a high late March, and then continue lower into late April, early May. May 8th comes up as a potential low point. Okay. Later in the video, I'll talk more about the long-term story for the year and for the next year or so. However, right now I want to go deeper into how we figure out what's happening in the short term. And what we do is we have what's called a wave mechanical approach. Wave mechanics is a fancy name for basically adding together waves. And the waves we're adding together are cycles. If you think of a cycle, most people think of a sine wave that goes up and down in a very uniform and very even way. And it turns out the short-term cycles may look like sine waves. The larger cycles very often are not sine waves. And so it's important to recognize that also there's more than one cycle running around at the same time. You have different size waves, different size magnitudes, different size duration. And because of that, it's necessary to know where the variety of the whole group of these cycles are. And I want to show an example of how wave mechanics works. So we have three little short-term cycles that are all different than each other. And we put them up individually on this chart. This is the first one. This is the second one. This is the third one. And they're all slightly different, and they're all somewhat accurate in terms of forecasting certain parts of the ups and the downs of the market. But what's interesting is if you average them together, if you add them together, combine them exactly according to their magnitude and point by point, day by day, minute by minute, you'll get this wave mechanical addition. The green here ultimately overlaid upon the spaghetti that you see in the three that are all there. The green is the composite wave, and that's what we anticipate is the actual market. The market is a composite of a number of different waves. Okay, so looking at what the green waves do going forward is ultimately what we come up with as a forecast. And in this case, we're calling for a low in a few more days, and then it goes up. But what's interesting about this model is that same pair, that same set of three cycles, if you had used it on and on and on the last 10 years, and you took only the long trades, and the reason for that is the trend has been up for the last 10 years. So if you follow a simple thing like the 200-day moving average and only take buy signals when the cycle combination turns up and don't take any trades on the short side, it actually was very successful for the last 10 years. And it made quite a bit of money if you look at it on S&P futures. Okay? And the same idea can work even further back, because at some point we're going to go into a bear market and the market's going to go down. What you do is in a market which has started to turn down, in other words, the 200-day moving average or a slow moving average has turned down, You take only the short signals that are generated by the downside of these cycles. And it turns out that made money in every bear market since the beginning of the S&P futures. And the other way made money in almost every up year of the S&P, going long only when the 200-day average is up. And the short-term cycles, you take roughly one cycle a month. It goes on for roughly 2 weeks, depending upon which short-term intervals we use. But this is a very simple way to beat the market if you follow the cycle approach and you understand that there are multiple cycles and you can't rely only on one of them. Okay. So one really clean example that you want to see here is notice how the summation wave in this model, in this chart, is down, and at the same time the market was down, and yet the yellow wave, one of the three waves, was up. And so what it shows is sometimes the combination, the sum of the ones going down is more than the one going up, and the summation wave will go down even though one of the cycles is still turning up. And this is the complexity of life, but it's the way it actually works, you know? So ultimately, the market is always the sum of many cycles, but they're not always the same cycles. Otherwise, you could draw a map going forward for 100 years and it would be correct. The reality is there are new cycles that come in, but they stay long enough so that you can make money with them. And then they switch to another set of cycles and you have to use those. So it's not that, it's really quite simple in principle, but you need the mechanisms to figure out, you need to know how to figure out which cycles are running at which times, okay? And this is ultimately what we teach in our Trade Forecast Mastery Masterclass, which we're going to be doing again, which our next class starts January 19th. So for those who want to figure out what we actually do and try to stand on your own feet, you know, the idea is to teach people the tools that we use, that they can use them themselves and become self-sufficient. Okay, now for more information for the swing trader level. So we've used the intermediate term cycles, basically are the 49-week cycle and the 54-week cycle have been very reliable on and on and on in a number of markets. And the 49-week cycle, the most accurate, 3 times it, 147 weeks, has been the most form-fitting to the market for a number of months now. And basically what it calls for, and we talked about this in the last video, it calls for a down month in December, which did happen, an up month in January, which hasn't started yet, a decline in February through April, which may be fairly meaningful. And then that agrees with the 54-week cycle, which has been inverted. It's been working, but it's been working consistently upside down. So you can use it to forecast if it continues to do so. And it also called for a low early January, a high late January, and then a decline into April. Okay, so that's pretty much the setup that we're expecting on the intermediate term. On the long term, we have to use bigger cycles. And we're using 3 primary cycles. The 7-year cycle. In this picture, you can see how the 7-year cycle has been repeating for the last couple of years at over a 95% accuracy. It's been the most accurate pattern that the market is repeating. And then the 60-year cycle, which historically is probably the most useful of all long-term cycles in the Dow Jones Industrial Average and in the S&P. It's been repeating for multiple years. The most recent few years are repeating at about a 93% level, and it's almost exactly 60 years ago. It's only a few days off. 60 years ago is very, very similar to what's happening now. So we're just going into the early part of 1965. And you can see that one individually in this chart and how it matches. The third pattern is the 88-year cycle, and that's based in going from 1936 into 1937 has been repeating very, very well. It's close to 89 years. And that cycle also has been extremely accurate, over 90% correlated for the last couple of years with the present market. And then we do the final stroke. We add the three together to create this wave mechanical understanding of what the future is likely to look like. We project it in the pink. Underneath, you can see this pink summation wave. And ultimately, that's the forecast that we expect the actual market to do going forward into early 2027. And we do expect a bear market to start in August of 2025 after a variety of different gyrations, including first going down potentially close to 5,000 by May. And then a very large rally over the summer, which could take us finally to somewhere around 7,000 on the S&P. And then we start a 18, 19-month bear market to go on into early 2027. Okay, so that's the super long-term forecast. And now you understand the mechanics of how we figure it out. Okay, so have a good trading week and look forward to volatility this year. It's likely to be a crazy year.